Hello everybody, welcome to another video in my video series, The Profitable Investor. My name is Mark. This is a video series I created to help you become a better investor. And in this video, we are going to talk about position sizing. Now, I've already done a video on 3 ways that you can manage your risk and you can protect your money in case something bad happens. Position sizing is one of those 3 ways. The other 2 are stop loss orders and hedging. But of the 3 ways, position sizing is the most clear cut. It doesn't take a rocket scientist to know that if you have $100,000 and you take $5,000 of your money, you cannot lose more than the $5,000 you're investing. Your total risk is 5%. It doesn't matter if your stock goes bankrupt or if the market crashes down to zero. You cannot lose more than 5% of your money. Now, there is one exception, and that is if you are a short seller. And what short sellers do, instead of buying shares of stocks, they borrow shares from their broker and they sell them back to the market at a high price, and then they hope to buy them back at a lower price and then profit during a falling market. Now, the risk is that if the stock goes up, you start to lose money, and if the stock doubles and goes even higher, you will lose more than your initial investment, whatever that is. So position sizing will not protect your account if you're a short seller. You have to use the other strategies, stop loss orders or hedges. You can't just use position sizing. But except for short selling, position sizing is a great strategy whether you are buying stocks or options, futures, or Forex. It's a great way to manage your risk. Even penny stocks are okay as long as you use really small position sizing. Maybe you have a lot of money, $100,000. You could take maybe a couple $100, buy a penny stock, and not even worry about it, right? Every strategy has advantages and disadvantages. And position sizing, the advantages are, number 1, it's very simple to understand. You don't have to know anything about stock options or protected puts or hedging or what's a stop loss order, a market stop loss or a limit stop loss. It's very simple to understand. You have some money and you take part of that money, and that's your position size. Second advantage is that you can diversify. Diversification in and of itself does not lower your risk of losing money, but it will increase your chances of making money. Think of it as a numbers game. The more stocks you buy, the more chances you are of winning in the long run. And the third advantage is liquidity. You don't have to worry about it. Penny stocks are well known for not being very liquid. If you buy a penny stock, you're probably not going to get a very good price because there's no volume. Not very many people want to buy penny stocks. But if you use a really small position size, let's say a couple $100, and you buy a penny stock and it's only going for a couple cents a share, you know, if that penny stock were to shoot up to $2 or $3, you know, if it took off, you can make good money. And even with the lack of liquidity, you're still going to make a decent return. So you don't really have to worry about liquidity the way you would, let's say, with a stop loss order. You know, good luck trying to get your stop loss order filled on a penny stock. But with position sizing, you don't really have to worry about that. Fourth advantage is you don't have to worry about your timeline. You don't have to worry about options expiring. You can just buy your stock or whatever it is you're investing in, and you can keep it there as long as you want. It's very flexible. Now, there are some disadvantages to using position sizing, and one of the big disadvantages is you will make less profit. For example, if you had $10,000 and you took all $10,000 and you bought a stock, and then that stock went up, let's say 10%, you would make $1,000. But if you used a small position size, let's say 5%, that would be $500. Well, 10% of $500 is $50. So instead of making $1,000, you would only make $50. So it does cut into your profits. And the second disadvantage is that it's not a good strategy if you have a small account. If you only have $1,000 and you only want to use, let's say, a 5% risk, that's only $50. You can't even get one share of many stocks out there. And even if you were able to buy a stock for one share, I mean, that stock would have to double just for you to make $50. You know, whoop-de-doo, right? So if you have a small account, it's not very good. You do need more money in order to use position sizing effectively. So if you want to use position sizing for your investments, I have 4 suggestions. Here they are right here. Number 1, save money and build your account, because the more money you have, the larger your position sizings can be. And number 2, accept that you are going to get modest rates of returns. Don't try to hit the home runs or the grand slams. Don't go all in. Just use nice small position sizings and you will get a modest rate of return. And number 3, use smaller position sizes for more volatile stocks, especially if you're going to buy leveraged ETFs or options. And you can use bigger position sizes for the less volatile stocks, the large caps and the blue chip stocks and so forth. And also you can combine other strategies to maximize your risk and reward ratio. So you can use small position sizes, but you can also hedge. You can sell covered calls and make income that way. You know, it's a great way to make the most out, get the most bang for your buck. So position sizing is a really great way to manage your risk. It will prevent you from losing money when times are bad. Learn to use position sizing as part of your overall investing strategy, and you will come out ahead in the long run. So that's it for this video. I hope you enjoyed it, and thank you for watching, and I will see you in the next video.